Hi guys, welcome back to the YouTube channel. In this video we've got a replay of a live training event that we did earlier this week, and it's all around property investors, how to structure your businesses in the UK, how to actually tax efficiently invest, reduce tax and maximise cash flow. Massively beneficial, lots of useful content in this. So if you're a property investor, you want to pay less in tax, check out this entire live training because it's definitely going to help you pay less tax in the UK as a property investor. Hello guys, how are you doing? I hope you're all well. Thank you very much for joining me tonight. We're going to be touching base on everything property related in the UK when it comes to property investment, and more importantly making sure that you're being as tax efficient as you can be. So let's get started as to where we are when it comes to the UK at the moment and what you can do to be more tax efficient. So we'll start by running through who is this training for, and it's designed for new property investors looking to build wealth the tax smart way, and also existing investors who want to minimize their taxes, and anyone in between who's looking to pass a portfolio on in the most tax efficient manner as well. So for anybody that's either just getting started or already in property, this is designed for you and to help you fundamentally pay less in tax. What are we going to cover? We're going to start with the basics, such as different structures that are tax efficient, how it's taxed. We're going to run through how to minimize profits and how the expenses work fundamentally, whilst also building a strong cash flow. Look at ways to take cash from your company, common reliefs and traps that investors fall for, and talk about the budget as well. Who am I? I'm Joshua Tharby, Chartered Tax Advisor and founder of JSM Partners, which actually set up way back in 2018 now. And since then, I've worked with thousands of landlords along the way, helping them reduce their taxes and build wealth the right way. So landlords, as we know, taxes have only gone up over the past decade. It started with Section 24. Section 24 for landlords investing in property in their own name. That made a lot of landlords incorporate or stop investing in their own name. And unfortunately for a lot of landlords, basically trapped them with their property portfolios paying exorbitant amounts of tax because they couldn't incorporate them or they didn't want to sell those properties. And then we had the changes to tax rates, corporation tax increasing, allowances being frozen. And then most recently as well with the previous budget, basically the furnished holiday let regime that was abolished, which that was a saving grace for a lot of landlords, was actually they converted their businesses, their property businesses over to furnished holiday lets, which helped with the impact of Section 24, but now that's gone as well. And the real kicker for furnished holiday let is, well, actually, if you do have a property in your own name, you're still subject to VAT. So if you go over the VAT threshold, you've got VAT to contend with, plus you can't fully deduct your mortgage interest. So actually investing in property, especially furnished holiday let in your own name, is an absolute non-starter. It's clear that the government are very much anti-property. I think is just this week I saw that Lloyd's, I think they're definitely £1 or £3 billion property portfolio now. It's certainly that's the government policy. They want these large corporates, BlackRock, buying properties, and they want the smaller landlords out of the way. And they're doing this through tax policy, amongst other things as well. But it may seem like bad news, doom and gloom. You're probably going to switch off, give up property investing, and not even get started. If you are looking at early stages and just looking at getting started, might actually completely put you off property investing. But this is the opportunity. Many smaller landlords being pushed out makes way for market opportunities for the landlords that do want to actually build significant wealth in property and are happy to jump through the hoops, the challenges, and overcome the hurdles along the way with the new renters reform bill and everything else, the tax landscape. For people that are willing to navigate through this, there's certainly lots of opportunity. And that's what we're seeing at the moment with our client base. Is it is challenging in terms of interest rates are high, although they are coming down. But on the flip side, rental yields are going up with rents going up. Massive queues for properties, especially good quality accommodation. It isn't a shortage. So for people that are willing to actually look at the market, evaluate the conditions and work within this, property can be as lucrative as it ever has been. Yep, many of the tax benefits are no longer there, such as being able to deduct your interest, lower corporation tax rates, personal allowance is going up with inflation, basic rate band's going up with inflation. But with the right property specialist, accountant, taxes can be minimised. Although, I'll be honest, if you're making money in property, people will say, oh, Josh, can you get rid of my tax bill? I always say, if you're making good money, expect a good tax bill. But with the right accountant, you'll know that absolutely everything is being claimed for, all the reliefs are being utilised, and you are paying the least amount of tax possible, which, if you're structured right, can definitely still make it worthwhile investing in property. The first consideration when planning for property taxes is structure, of course. When you're buying property, when you're investing in property, structure is the most important consideration, because off the back of that drives pretty much everything tax-wise. For most people, it's a case of investing in your own name or a limited company. Of course, there's partnerships or LLPs, but from a tax perspective, that's usually just treated as two individuals investing in property in their own name. What does it mean to actually invest in property in your own name? You personally own the property, so you will own the property in your own name on land registry. It's just your name, or yourself and your partner's name if it's jointly owned. You pay income tax on the rental profits without a deduction for mortgage costs. This is the whole Section 24 side of things, your marginal tax rate. And what that means is if you're already a higher rate taxpayer, paying 40%, that gets lumped on top of that, and you'll pay 40% tax on your rental profits, not deducting mortgage costs. And then for the mortgage cost, you just get a 20% tax credit against your final income tax liability at 20% of the mortgage expenses. So for anybody who's a higher rate taxpayer, it's bad news. And what does this actually mean? So as a higher rate taxpayer owning property in your own name, best case, we say circa 50% there. We've got some clients where they lose money by owning their properties, especially if you're near the child benefit threshold. You've got other reliefs, you've got significant over income. We've actually seen it where when we've done the numbers for a client, they're actually paying more tax than they are on their profits. And it's until you actually crunch those numbers, if you've got an existing property portfolio in your own name, that you realise that and think, wow, I need to get this property sold because I'm losing money on it. For some, and very, very few, I'll be honest, investing in your own name can still be the best option. Really, the only time we ever recommend it or is remotely feasible is if you are a basic rate taxpayer, you plan to remain a basic rate taxpayer, and you literally just want a couple of buy-to-let properties to supplement your income, replace your income, and you have no intention of going anywhere near the higher rate territory. So literally a couple of buy-to-lets, then that might be okay in your own name. But for most people here looking to build a large portfolio, you want to focus on reinvesting profits to fuel growth. This is where a limited company is the best option. Why? Because you can deduct the full mortgage interest. You can snowball profits at lower tax rates, so 19, 25%. That's the corporation tax rate. You've got flexible income extraction and inheritance tax benefits as well, which we're going to touch on. So when you are building wealth, you're refurbishing properties, you're doing BRR, you do it all within that tax efficient wrapper, rather than it being on your own name where you're losing half of the rental income immediately in taxes before you even get started on the next property and reinvesting. A simple limited company has shareholders and directors. You can both take salaries, equal dividends, and the value of the company is yours and subject to IHT. I've mentioned this here because this is often overlooked, and we're seeing it a lot at the moment, is people have built up significant property portfolios using a normal limited company because they thought that was the best way. And certainly it's better than investing in your own name, but it creates a massive inheritance tax problem. So here's an example. Property Investing Limited, 2 shareholders, husband and wife, nice and simple, 25 buy-to-lets, a nice 9k a month net cash flow post-tax. Of course, here the tax efficient salary, 12,570, and I know we talk about tax, but this 12,570 has been frozen, I think, for about 2 or maybe 3 years now. And it's quite likely in the budget it's going to be frozen even further. So I'll probably have this number stuck in my head for a good another 4 or 5 years or so. I'd imagine up to 2030. I think they talk about extending that up to. Rest of the income taken as dividends, 50-50, probably up to the higher rate band. And then usually the rest is left in that company to be reinvested. For inheritance tax purposes, the net equity, so the current asset value less all the liabilities, any mortgages or director's loan account, is 1.5 million. And this, for inheritance tax, is split 50-50 between both shareholders, which means broadly that each shareholder here, each husband and wife, would have £750,000 of chargeable assets in their estate for inheritance tax purposes, which, as you know, if you've got a main residence, any of a property, that's a lot of money exposed to IHT at 40%. But there is a way that we can get smart with setting up limited companies with something called alphabet shares or family investment companies. Like I mentioned earlier, a normal company has normal shares. They've all got the same rights. You'll literally set up a company at a company's house. If you set your own company up, it probably asks you all the different specifics of the shares. You just put ordinary shares. All shares are equal. However, when you do set a company up with a solicitor or a good accountant, you can actually modify the share classes to give yourself an advantage that works for you and your tax position. An easy use case for this is allowing different dividend rights between shareholders. So this allows for flexibility where one doesn't need the dividends or where one pays tax at a higher rate. Great example, married couples where one's a higher rate taxpayer, one's a lower rate taxpayer. We don't want to be taking out dividends as a higher rate taxpayer if we don't need to, because you're paying 3.75% tax on those, whereas actually the lower rate taxpayer would only be paying 8.75%. With a normal limited company, dividends are declared equally and legally taken equally, whereas when you've got the alphabet shares for the different dividend rights, you can pick and choose which shareholder gets the dividends and which doesn't. An advanced use case is a family investment company, and this is where you have multiple share classes with the founding generation having limited capital rights. And what the capital rights are is that's the basically rights to the actual fundamental value of the company if it were wound up and all the capital distributed. So what this does is it reduces the value of their shares. However, they're still in control and they can take income. This is a great use case for usually somebody who's got some money. They're starting to invest in property. They want to control the company. They want income rights, but they know that they want to pass this property portfolio on. And the family investment company is a great structure that allows them to achieve that. The shares with the capital growth are either given absolutely to the next generation, or quite often we see them put into a trust. Most people don't want their younger children to turn 18 and inherit a significant amount of wealth, because who knows what they'll do with it. So usually some kind of discretionary trust is included within that structure just to protect the family business and the family wealth fundamentally. And all of the initial funds that the founding generation put in usually goes in as a director's loan, and that can be taken tax-free. The effect of this is that the growth of the company, the growth in value of the company is not in the estate of the founders, because they've probably usually already got significant wealth, main residence, usually sold a company, they've got other things going on, decent pensions, but actually it goes straight to the next generation or contained within that trust, and that avoids inheritance tax of up to 40%. The main consideration with family investment companies is cost. Typically, they cost upwards of $10,000. We're working on one at the moment for a client that just sold their company. They've got about £800,000 or £900,000 that they're looking to deploy into property investment. And for those guys, they've got significant other assets. They know that this is a long-term play where they just want the income from their property portfolio, but they want the wealth to be safely secured and passed down to the next generation. So actually, there's a clear cost-benefit analysis. So if you are looking at building a large property portfolio, you've got a decent amount of funds available to put into the company as a loan. A family investment company can be a great way to go. If you're not sure which way you're heading, for sure, you could start with a normal limited company or one with just alphabet shares for the dividend tax advantages, and then potentially transition to a family investment company at some point in the future. Because for a lot of people, £10,000 or so plus VAT to get set up as a family investment company can be a big hurdle and a big additional expense when you're looking to get started in property. And then lastly, on the area of structures, we're going to talk about group structures. So rather than you owning your company directly, a lot of people, this is usually the de facto way of doing it. You own a trading company, Josh Tharby is listed as shareholder and director. You might have a separate company. Rather than owning your individual businesses yourself, you insert a holding company above the trade co, and the holding company then in turn owns all of the subsidiary entities, such as your trading company, property investment company, as a group. Just like this here, so holdco, tradeco, any SPVs. and then you would actually be the shareholder that owns the shares in Holdco, and then Holdco owns the shares of the two subsidiary companies in this example. And the main benefit here is this allows you to take profits from the trading business to the group co tax-free. So this, usually when we see this as an example, they've got a risky business, a trading business. Any form of trading business is, in my view, a risky business, because if something goes wrong, somebody could sue you. You could, potentially have a creditor could sue you. You could go into business trading troubles, something like that. You don't want all of your long-term savings sitting on that balance sheet, because if something does happen to that trading business, pop, they're gone. But what a group structure allows you to do is get them out of harm's way. It's going to be paid out as a dividend, because when you own the company in your own name, with you owning the shares, you don't take out all the money as dividends because you pay a lot of tax on that. But where you've got that group structure, you just take it out as a dividend tax-free to that group co, and then it's out of harm's way. It's no longer cash sitting on the trading company's balance sheet. It sits in that completely separate limited company and is secure and safely stored. And with that group structure, you can then either start to invest in stocks, shares, crypto, property, anything else, and you can sleep easy at night knowing that it's safely invested rather than sitting on the balance sheet of the trading company. The property business is a separate entity, therefore it's not subject to the risks of the trading business. With a limited company, like I mentioned, they're separate legal entities. So whatever happens in the trading business or the property business, just because they're part of a group, they're not linked from a legal perspective. And another tax advantage for this structure as well is when the trading business is later sold, the sale's often tax-free with a substantial shareholders exemption. So rather than you having to pay either the tax at 14 or 24%, whether you qualify for the business asset disposal relief or not, and in your own name, you can actually just sell the company as part of the holding company structure as a subsidiary, and you can get the SSE 100% tax-free in a lot of cases. And this structure is also great when you're looking at multiple property strategies as well, such as deal sourcing to generate cash flow, rent to rent, whatever it might be. You can invest the profits out tax efficiently into the SPV. A SIP or a SAS can also be incorporated as part of the structure for further tax benefits, but there are potential rumours about the income tax relief being changed on pensions. As we know, they're now subject to inheritance tax as well, so pensions have definitely lost their appeal compared to 12 months ago, say, but we'll keep this one wide open to see what happens in the budget in about 14 days' time and exactly where we end up on that. Best structure, it depends on where you fit with what we've covered, limited company, FIC, group, but you're kind of well informed now as to what fits you, what fits your objectives, and what's going to help you build wealth the most tax efficient way, and certainly pass it on as well. So day-to-day tax planning opportunities. Income planning, of course, you've got the business set up. You want to take salary from this. For most, the 12,570 as a salary is still the most tax efficient. Anything over and above this is dividends. And like I mentioned earlier, it's expected to remain this way for some time. 12,570 falls within the personal allowance. You've got 500 dividends of tax-free. And the remainder up to your basic rate band, 8.75%. And this is usually what people do, is they take the 50,270 because you don't want to pay 33.75% higher rate tax on that dividend income. Here's a little chart that just summarizes it there. You've got your 12,570 plus the 37,700. And these are the tax rates. On the left there, 20, 40, 45. That's on earned income typically, so interest income, rental profits, so self-employed income, employment income, and the 8.75, 33.75, that's on dividends. Income tax jumps significantly once you get over that £50,270. Double this for married couples, so you get about £100,000 out of a limited company with a 6k income tax bill. Overall, it's not terrible. It's pretty tax efficient if that's a if there's a survivable amount of income for you in your personal circumstances. And of course, we mentioned here, your partner can be on the payroll, 12,570. There's usually no issues, no kickback from HMRC for a salary of that level. There's not too much that you have to do to justify paying out in a salary to your partner. But to ensure the payroll is deducted, it must be run through a payroll and actually paid. And also, as a wider tax tip, consider salaries to other family members. Your retired mum with a basic rate band available, child to university, you might help with some viewings or some property admin where you can, and they've got either their personal allowance or basic rate available, look to pay them a dividend. Reason for this, it reduces the corporation tax in the company, and they're between 19 and usually 25%, but there actually is the marginal rate of 26.5%, and income tax top rate of 20%. So actually the tax bill is lower and the money is extracted, and that's a win-win. When you loan money to your company and you don't take out expenses, this is what we call a director's loan account. So especially for property investors, you put a large amount of money in to fund the initial purchases. How is this treated? It's a director's loan. It's a loan from you to your limited company. Same with your mileage, any assets you transfer. This is basically your personal wealth, your funds that you put in to benefit the company. And of course, you can take them out tax-free as part of your director's loan. But what a lot of people do miss, even still to this day, is actually charging interest on their director's loan. So because you've lent money to your company, just as if you would go get a mortgage or some kind of bridging finance, some sort of other third-party finance, they would charge you interest. And actually, just because it's your own company, your own money, that doesn't mean you can't charge interest. So here's a great example. Over a number of years, a director's owed £250,000 from a property investment company. Very typical. Over a number of years, putting money in for deposits and whatnot. And here, interest rates, it's got to be market value, but you try to borrow £250,000 unsecured with no fixed payment terms, most people are actually going to say no, let alone offer it you for 20%. But anywhere between 10, 15, 20%, we see pretty much accepted from HMRC. So that means you could charge 20% interest on your director's loan of £250,000, which is, of course, £50,000 of interest, and that's fully tax deductible in the company. And if you were a full basic rate taxpayer, only subject to 20% top rate tax. And of course, you've got your allowances to offset against that as well, your personal allowance, personal savings allowance, savings nil rate band. So actually, that's a very tax efficient position to be in, because that's 50k extracted with a very, very low tax rate. So if you wanted to, you can actually engineer it so you could get 18,570 completely tax-free by using the personal allowance, the savings allowance, and that savings nil rate band. And it would make sense to top that up even further to the full 50,270 if your director's loan account were large enough. One admin point to mention is you must complete a Form CT61 within 14 days of actually paying the interest, and deduct 20%, pay it over to HMRC, and then you reclaim this tax credit on your self-assessment tax return. If you owe your company money, that's a bad position to be in. You have Section 455 tax, which your company has to pay, and that's a whopping 33.75% if the loan's outstanding 9 months after your company's year end. Where the loan exceeds £10,000 also, your company must charge you interest on your loan, on your director's loan at 3.75% to avoid a benefit in kind or having to file a P11D for that benefit in kind. But this creates an opportunity in that you can borrow up to £10,000 from your limited company as long as you repay it within 9 months from the end of your company's year end. When it comes to reducing corporation tax, expenses are key, as you, of course, can't reduce income. The more tax deductible expenses you have, the lower the tax bill, and we've covered salaries and interest so far. But quite often we see people misunderstand how actually claiming tax back on your expenses works. You basically get tax relief. If you get tax relief at 25%, you're actually still paying out 75% of the money. So don't get into that trap of spending unnecessarily because you think it reduces tax. Yeah, it does, but you're actually still picking up the tab for 75% of that expense. Claim a tax deduction for using your home as an office. This is a big one that we see missed quite often as well. There's two ways of doing this. Flat rate of £6 a week, nice and simple. You don't need to keep any records. Or if you do spend a significant amount of time working from home, you can actually charge rent to your limited company. The way you do this is you must calculate total variable costs, mortgage interest, rent, utilities, everything that kind of goes into you being able to work from home. And then you can use a number of rooms or square meters of your home office. to determine a reasonable basis of apportionment. There's no set guidance from HMRC on this, but as long as it's reasonable and you've got a calculation to support it, it's usually accepted. And then you basically, if you were to use a number of rooms, you've got 5 usable rooms, not including kitchens and bathrooms. You would then just divide your total household running costs by what you deem to be used as a home office, and you can claim that as an expense for your company. So here we've got an example: total household costs of £20,000, 7 rooms in the house excluding bathrooms and kitchens, 1 is your home office, 20,000 divided by 7, that's 2,857 that you'd be able to look to charge to your limited company for working from home. That's much better than the £6 a week. If it's a personally owned property, using an element of the building for exclusive business use can impact your primary residence relief, the CGT relief that allows you to sell your house tax-free. So it's best to basically state it's a non-exclusive business use. So rather than claiming in that previous example the full amount where we divided it strictly by 7, we'll actually divide it by 7 and then times that by 0.9 to say actually we're using that room for domestic purposes. We store some washing in there, use the ironing board in there 10% of the time, so it's non-exclusive, and thus that keeps PPR fully open. The income for this would be reporting your self-assessment as property income, with the expenses that you also allocate offset against that to effectively wipe out. So the rental income you charge minus the expenses basically produces no profit on your tax return. The rent is, of course, tax deductible in the limited company, and it can be paid out in cash or just increase your director's own account for you to take later tax-free. Travel, that's a big one. Travel's a really, really big one, and where possible, you want to try and live vicariously through your company, so that if you are going somewhere and it is further afield, or can you make it for the purpose of the business and include it as an expense for your limited company rather than using personally owned funds? A great example of this, especially at the minute, is these kind of masterminds and things like that. That can be significant, traveling overseas. Or if you're just traveling in the UK, you're viewing properties in an area. Well, actually, if you are strictly going up to Huddersfield or whatever you might go, so view properties, you're staying in a hotel, the whole cost of that plus the travel up there is tax deductible. And then, of course, we've got the overseas masterminds and retreats that are very popular at the minute in all different areas of business and wealth that are often held somewhere sunny overseas. Of course, because you're going there to actually learn new skills, learn or develop your skills as a business owner, you can claim this as a tax-deductible expense through the company. Ensure all expenses are claimed where possible. You've got to keep details of receipts, and you've got to be able to justify it to HMRC. What we say to clients is when you're thinking about trying to justify something, just imagine that on the opposite side of this table, an officer from HMRC is sitting there, and you've got to be able to say with a straight face why you thought that was a tax-deductible expense. Use an own vehicle for business purposes. Old but gold here. This 45p hasn't changed for ages as well. It definitely should do with the cost of running a vehicle and the cost of petrol. We've got 45p a mile for the first 10,000 miles and then 25p thereafter. Do keep a log such as the date and destination, reason for travel. There are apps that do this for you, MileIQ and TripCatcher. Common question, is property or business training tax deductible? So a lot of people often get started by going to some property training course, whether that's Progressive, Touchstone, Samuel Leeds, whatever kind of camp you might be in. Yes, this is absolutely tax deductible. It's best to get your company set up first if you can before incurring any expenses, and make sure you've got any paperwork, invoices, receipts addressed in the name of the company. Company cars are still tax efficient. Just because you're a property investment company doesn't mean that you're not eligible to have a company car. Ultimately, from a tax perspective, you're still a limited company, so you can access all of these tax reliefs. Commercial vehicles, electric vehicles are the most tax efficient at the moment. With a lot of the hybrids, they're reclassifying the Euro, the emissions side of things. So a lot of the hybrids are actually not as tax efficient as they used to be. But electric vehicles and commercial vehicles are still very good to go through a limited company as a tax write-off. Leased cars, you can actually claim the monthly payment each month when it's paid. So if you pay £300 a month for a car, that just comes straight off of the profit and loss at the end of the year. And if your business happens to be VAT registered, you can usually reclaim 50% of the VAT as well. If you purchase an electric car or a commercial vehicle, you claim something called first year allowances, which allow you to write off 100% of the cost of the vehicle when you purchase it. So, e.g., profits prior to purchase, £60,000. You purchase an electric car, commercial vehicle before the end of the year for £60,000. Well, actually, the full purchase is deducted, so you've got no profits for tax purposes and no tax to pay. Trivial benefits, hopefully everybody here knows what that is, but if you are a new property investor, a new entrepreneur, you probably don't. Basically, this is designed for kind of ad hoc gifts for employees, like their birthday gifts, a little bit of a gift at Christmas. And essentially, as a director of a limited company, you get £300 a year annual cap, and each trivial benefit, each instance can't be more than £50. There's a few kind of strict definitions that it can't be reward for employment services, can't be contractual, it never is. How we say to clients to fully maximize this relief is to use the company debit card and just buy some gift vouchers for your favorite shop. Amazon, John Lewis, Sainsbury's, wherever it is. During the course of the year, every 2 months or so, go buy a £50 gift voucher. You can then use that money personally to spend on whatever you want. The company gets it as a tax-deductible expense, and this is doubled up as well. So if you've got more than one director, everyone is eligible for this relief through the company. Christmas party allowance, £150 a year. It's quite convenient. We're coming up to Christmas. £150 a year. You can just go out for a company meal, use the company card, and there's no other tax to pay on that as well. And it's doubled up. So if you've got other directors, staff, £150 each, that's fully tax deductible. There's no benefit in kind to worry about for using that company card for a nice, fun meal. Directors and employees, of course, you get one mobile phone tax-free. The contract must be in the company name. That also extends to other assets as well, MacBooks, iPads, where possible. If you're buying a bit of equipment and the company can use it, try and justify it going through as a company expense rather than using your own post-tax income to pay for that. Get it as a tax deduction, so you're saving less tax and you're also not paying tax or using income where you pay tax on it. If you've got any assets that are already used in the business, so if you've already got a MacBook, for instance, where you set your company up, well, actually, what is the value of that MacBook when you started using it for the business? You can sell that to your limited company for the current market value and get a tax write-off for it, and also get some money out of your company tax-free by increasing your director's loan. Tax trap. A lot of people ask, can I prepay some expenses? Can I prepay next year's rates bill or accountancy bill to bring this profit down? No, limited companies use the accrual basis, and what this means is it will basically get marked as a prepayment, and you'll actually get tax free for it next year when it's actually in the period it relates to. And also, we've seen a lot of this at the minute: SDLT repayments, a lot of uninhabitable properties, MDR, whatever it might be. There's a lot of firms popping up that aren't tax advisors or qualified accountants in any way, shape, or form, offering these repayments. And the way any sum of even R&D tax credit, stamp duty repayments, the way it works is HMRC process the claim and actually repay it and then investigate it 12 months later. By that time, you've had the money back, you've paid the consultant for doing it for you, they've disappeared, HMRC aren't happy, they want the full tax back, and you're left out of pocket. So guys, I really appreciate your time today. That's all we've got time for, but I've got a few touching words before we hop into some questions at the end. And it's, as you've seen during this presentation, learning how to reduce tax is good, but it's only as good as your accountant. You're here today learning about tax, which is fantastic, but your accountant should be coming to you with these sort of tax planning opportunities. And your accountant is your most trusted advisor, responsible for your biggest expense in life, your tax bill. If they're not property tax specialists or they only prepare basic accounts, you are most likely overpaying in tax and as a result destroying your wealth. My team at JSM specialise in tax planning and helping investors pay less in tax. As soon as you join us, we review your entire business and future plans and create your bespoke tax strategy, helping you achieve your goals sooner. Every year we review this strategy to make sure that you're on track, and if anything needs optimizing or adjusting, and identifying further tax reductions where we can. To book a call in, go to jsmpartners.co.uk/join. And if anybody's got any questions, we're more than happy to cover them now. Okay, so perfect time to answer a few questions. Kyle, so how are lenders viewing advanced shareholdings? Parents had issues with buy-to-let lending with Alphabet shares. To be honest, We've never seen any issues, especially with just ordinary alphabet shares. The basic lenders look at those just like any normal shareholding. Usually what they're focused about is kind of percentage shareholdings to just make sure that everybody who's got 25% is usually party to the mortgage. So that can be a problem sometimes with a family investment company where you kind of get aggressive with the different shareholders. But for a normal company, I've not heard of any issues at all. With a family investment company, it can be, but as long as you get a broker involved and you do the share structure right to start with, it's still very possible to get decent mortgages with that structure. So we're based and resident in Guernsey, but previously from the UK. I have a couple of personally owned buy-to-lets before we moved overseas. Going forward, planning up setting a UK-based SPV to purchase property. So for that, so especially with the initial funds, yeah, for sure. So in terms of the actual, UK limited company to purchase a property absolutely makes sense. There's no advantage to having overseas property anymore within a UK-based property in an overseas company rather. Those kind of advantages long but closed. But yeah, there's definitely some sort of tax advantage you could have either by loaning the money personally, charging interest on that, or by having a Guernsey SPV to loan the funds across. You could look at a management charge as long as you can justify it and actually it's market value arm's length. You can't just wipe out all the profits conveniently every month with a management charge unless you could prove it was market value. But yeah, there's definitely benefits to be had by all on that capital charging interest on that and actually charging a market value management fee as long as you can justify it. We have 5 buy-to-lets in our name. What advice, partnership or company? Well, if they're in your own name, I suppose they're stuck there for what? It's a great question because with kind of the aim of that question there was, potentially should you partnership or should you incorporate? And that is definitely a hot topic at the minute. So a lot of landlords are either partway through incorporating or still thinking about incorporating. And it's worth mentioning to everybody here that it's no longer as risk-free as it used to be. So previously, when property incorporations first started, probably 7 or 8 years ago, it was completely accepted. It was risk-free. There was no known challenges. You could even get HMRC approval for it. Whereas they stopped the pre-approval process, and there were a couple of aggressive players, Property 118, less tax for landlords, and they basically had contrived aggressive schemes, which have brought a lot of heat on property incorporations themselves. And now some big tax commentators have highlighted that actually just a vanilla property incorporation could also be subject to the tax avoidance rules and potentially overturned in the event of a HMRC challenge. Because what they're arguing is that the contrived step of you coming to me now saying, shall I form a partnership to incorporate, because that's how you can do it tax-free, that is a contrived step. And as a result, it's a tax avoidance scheme. And then also as a result, you can't get the stamp duty relief because it's overridden by the genuine anti-abuse rules. But if you can, try and get them into a company, whether you just sell them at market value or if you can incorporate and pay the stamp duty, because, you can still get the incorporation relief under the Ramsey case, but there might just be a stamp duty liability, or consider setting up as a partnership at the minute, get the income tax advantages and just seeing which way the wind blows with HMRC's activity on property incorporations. Can my property company register for VAT? Not unless you're making VATable supplies. So just a normal buy-to-let HMO company can't ever register for VAT at all. If you're doing serviced accommodation, commercial property, deal sourcing or something which is subject to VAT, then you can. I read that if you buy commercial mixed-use property, you could benefit from unused capital allowances. Yeah, you can do, especially with the commercial properties. It can be possible, depending on whether the capital allowances have been claimed, for actually you to identify those capital allowances and claim them if they've not been claimed already. Can an overseas director be paid a salary or have a company vehicle from a UK SPV? Yeah, absolutely can. Yeah. So any salary or company vehicle, that's absolutely fine, even though you're based overseas. Do you pay stamp duty if it's a gift and no mortgage? No, you don't. So actually, stamp duty is one of the only taxes that's actually based on consideration. So you only be liable to stamp duty if you take on a mortgage to purchase the property or take over a mortgage because that's deemed consideration, or actually the cash price you pay. Of course, that's different to CGT, whereas actually if you transfer property, you always pay the CGT. You mentioned there, so gift from personal to limited. Actually, in that case, there's an overriding charge, which basically means because you're making a transfer to a connected company, you do pay the stamp duty. But if you were to transfer between personal people, yourself, friends, family, whatever you might do, then stamp duty. There's no connected company provision, and there is no stamp duty, but there would be if you were to transfer it to a limited company in which you are a participator. So with a limited, if there is personal use, that's not a problem at all. So you can actually have a limited company with a phone through it that is for personal use as well, and there's no benefit in kind. You can still claim the full expense of that mobile phone, the handset, the line rental, the SIM, even if there is personal use. You're allowed one per director, so you don't need to apportion that at all. Perfect. Well, I think that's all the questions. Really appreciate everybody coming on and listening to me talk about tax on a Wednesday evening. If you've got any questions at all, feel free to reach out to me or book in a call. I'd love to have a chat to see how we can help you build wealth and pay less tax. That's all for now, guys. Have a good evening. Bye.